Today is Thursday, December 17th, and this is a post-market review for the stock market activities today. And I do apologize ahead of time if you got this video a little late today because
I was busy in a meeting with the top bear families in the country.
and we were planning and orchestrating a market crash tomorrow. No, I'm just kidding. Not really. But don't tell the SEC. You know what? You want to tell the SEC? That's okay because they are asleep. But speaking of the SEC, we do have a lot of news to cover today about the state of the macroeconomy and the double lawsuit against Robinhood. Also have news regarding the war between Apple and Facebook. And then I have more information and more news in a segment I call Space Assholes about Jeff Bezos. And of course, I got the usual for you in the options market activities, but I'm also showing you today the massive trades regarding Tesla because we will see significant uptick in activities for this particular name tomorrow and next week. Remember, quad witching Friday is tomorrow. It's going to be very, very interesting to see what the top market players are planning to do. Furthermore, I got the charts, the usual for you, and stick to the conclusion of this video because I will show you that this has now morphed into a globally synchronized mania. What did we have today? Remember, these are the 4 layers of market protection that we are dealing with. Number 1, the vaccine optimism. That is already priced in. We're done with that. The only problem here is if things go wrong with the vaccine, meaning somebody dies from it, etc. That could rattle the market. Other than that, the vaccine optimism is already priced in. But we do have stimulus optimism, and we continue to bet the market higher and higher. Nobody's willing to sell until, of course, we see the final outcome of the stimulus bill. The third layer of protection is the split government optimism. We will know the outcome of that particular situation on January 5th after the runoff elections in Georgia. Lastly, we have the weak dollar layer of protection. Today you saw the US dollar sliding significantly, and that by in itself propped up the market higher. Of course, we do have, after all of this, underneath the market, the Fed's put. However, be careful about your assumptions for this particular layer of protection. With that being said, we do have a market to cover. And here we go. The Dow Industrial Average closing in the green, 148.83 points, or a gain of about a half a percentage point. The Nasdaq in the green, 106.56 points, or 0.84%. The S&P 500 up by 21.31 points, or a gain of 0.58%. What about the sector's performances for the day? We have a weak dollar. Guess what? Basic materials at number 1 and capturing the gold medal by far. At number 2, healthcare for the silver. And the bronze goes to consumer cyclicals. Lag in the day, energy, communication services, the only 2 sectors closing in the red. Moving on to the futures market performance for the day. And right away we see a green picture across the board. We have a weak dollar. Guess what? That is good for pretty much all futures, with very few exceptions on the board. Right away, you see it was a big day for crude oil, up over 1.5% for the session. What about softs? Coca up, cotton up, lumber up, sugar up. And you see massive gains specifically for lumber, closing over 2.5% for the session. Coffee muted, and the biggest loser is OJ, down over 2% for the day. What about metals? Big day for metals, naturally, as we see the US dollar sliding down. We see gold, silver, platinum, copper, all closing in the green significantly. The exception is palladium, muted for the session. What about meats? Gains for live and feeder cattle, but we do see lean hogs continuing the slide lower, taking a retreat for massive gains earlier in the week. What about grains? Big day for grains, soybean products, corn, wheat, rough rice, canola, all up massively in the green. The only exception is oats, muted for the session, but oats had a massive run so far. Moving on to the big casino, the options market, and let's see what's going on here. Right away, the most active tables in the casino. Apple at number 1 with over 1.5 million contracts. About 75% of those were calls. Tesla at number 2 with over 1.1 million contracts. About 60% of those were calls. NIO at number 3 with over 550,000 contracts. About 72% of those were calls. And here are the massive trades I want to show you. These are not unusual activities in my book. These are just massive activities. These are the big league trades, the Glengarry trades. I'm showing you these because we have an important quad witching Friday tomorrow and an important rebalancing for the inclusion of Tesla in the S&P 500. And right away, you see the monster trade for the Qs. They're buying the 280 puts, expiration date January 15th, with expectation that the Qs would decline over 10% from here. And this is a massive trade costing over $15 million. Again, they keep pumping the market every day, telling you that the grass is green, the sky's the limit. However, behind the scenes, they're preparing and they're buying protection for the next flush down that will come right out of the blue. And here's the massive trade for Tesla. Somebody bought the 700 calls, expiration date tomorrow. And again, this is why we call it a casino, because they are paying over $35 million for this trade alone that has only one date for expiration, making a massive bet that money managers will rebalance their portfolios tomorrow and they will bet and buy Tesla, causing the name to surge significantly. Because for this trade to be profitable, Tesla needs to rally over 7% by tomorrow. And this is what I wanted to show you for the massive unusual activities today. But we will go and cover the usual unusual activities that we cover. And here they are. We see more trades for the Qs, protection trades, aka bearish trades. Similar story with the IWM. And here we see another bet against the real estate ETF IYR. We saw some activities against the real estate ETF in the last few days, and here is a continuation. They're buying the 81 puts, expiration date New Year's Eve, with expectation that the real estate ETF will decline over 5.5% by then. And here we have another one for Penn National, the ticker PENN, and they are buying the 105 calls, expiration date New Year's Eve, with expectation that the name will rally over 15% by then. Again, this is an expensive trade because it is costing over $1 million. And here is a pretty unusual trade for the ticker AL. This is a company called Air Lease Corp. And they are buying the 45 calls, expiration date January 15th, with expectation that the name will climb over 6% by then. And they are paying about $1.50 a piece to enter this trade. And the last trade of the day that I got for you caught my attention for the solar ETF TAN, and they're buying the 105 calls, expiration date December 31st, aka New Year's Eve, and they are paying over $250,000 for this one alone. We saw more unusual activities for TAN, the ETF for solar, the last few days, so we'll see if the run can continue in solar names. Moving on to the headlines that shaped the day, starting with some macro news that we got in the morning. And here it is, the most important piece of news: the weekly jobless claims ticking again upward. Nearly 900,000 workers applied for jobless benefits in a week. And again, they keep telling us about this V-shaped recovery. V-shaped recovery, my ass. There is no V-shaped recovery. The picture is getting dire. We're trending backward toward a double dip scenario, and we will perhaps register the first net loss in employment in the months of December since the crisis started in February. And here are the particulars. The U.S. weekly jobless claims came at 885,000 versus 808,000 expected. This is a disaster. We were trending at 600,000, expecting that we will go to 500,000 and slowly walk our way to reduce the jobless claims. We are now ticking back upward, and the market chose to ignore this piece of news that would usually crash the market. However, because we have some remaining layers of optimism that I showed you in the intro of this video, specifically the stimulus. They keep dragging the stimulus talks, every day. But my hunch is once we pass the stimulus, the market is not going to like it. And the unemployment picture is projected to get worse because we heard the news from Coca-Cola. Here it is. Coca-Cola is planning to cut 2,200 jobs, including 1,200 in the United States, as it faces declining sales during COVID-19 pandemic. And the situation is getting very dire in terms of personal income and consumer spending power. Here it is. Every state in the United States saw personal incomes drop in the third quarter. And here is the map. Remember the slide that I showed you yesterday, that the last phase of consumer behavior during the COVID-19 crisis is exhaustion. But I expected that to happen after holidays spending. Now it is happening during the fourth quarter, meaning that the situation is getting more disastrous even faster than I expected. And here is more. The Philly Fed Manufacturer Index came in light in December at 11.1 versus 20, the estimate. We missed by almost half. The last reading for the prior months was 26.3. Massive decline in the Philly Fed Manufacturing Index. And you can see right away from the chart that we are curling back downward from expansion to contraction. If we continue in this trajectory, next month we will be in contraction territory. But rest assured, because this economy is still working for the rich and the 1%, the haves. Because here is the information we got in the morning. November housing starts stronger at 1.55 million versus 1.54 million expected. The haves are continuing to stampede, scooping up properties as much as they can. And unfortunately, there are some of the middle class who are experiencing FOMO, trying to chase the lower mortgage rates, even though the Fed itself yesterday said that they will keep interest rates as low as possible all the way to 2023. But again, dumb money continues to blow more air in the housing bubble. Moreover, we talked about the decline in personal income across the United States, and the Federal Reserve is making the situation even worse by the massive supply of currency they are producing in the market, suppressing the value of the US dollar. And you saw the Dixie, the dollar index today, sliding significantly lower, meaning that whatever consumer purchasing power that you have left is being weakened even more. Because here it is. The US dollar is getting crushed by rival currencies, and you can thank the Fed. Now, I want to hear from the Fed apologists who continue to attack me and say, oh, you don't understand. The Federal Reserve saved the economy. How the hell did they save the economy when we have almost 1 million people applying for unemployment every single week? Months away since the crisis started. How the hell did they save the economy? And I know what you're gonna say. Without the lending facilities and the free cash they showered the largest public corporations with, the situation could have been even worse. Those companies would have laid off workers too. Bullshit. Because here is the real data. 45 of the 50 biggest US companies turned a profit during the pandemic. Most of them also laid off workers, more than 100,000 in all, and gave the bulk of profits to shareholders, meaning that the Fed did not save the economy at all. All they did is save the rich and the wealthy from experiencing financial losses during the pandemic, because that is their secret mandate, to protect the assets of the wealthy and to prop up the assets of the wealthy. And they do it by assuring us retail traders and retail investors that they will have the back of the market, the aka Fed put, and they encourage us to pour our hard-earned money into the market to make sure the stock market is rescued. Not only that, but propped up to be traded at all times highs, so the rich can dump cash in their money and then they crash the market on our heads. We lose our money, we lose our livelihood, the market corrects, and then the rich use that cash they collected from us to buy back their stocks at cheaper prices and ride the ride higher again. Why are you participating in this scam, thinking that you will end up being a winner when this charade is over? Moving on to some Robinhoodiots news. What a bad week for Robinhood because it got hit left and right. Here it is. Robinhood is accused of gamification of trading by Massachusetts regulator, and they have released stunning data of amateur investors joining the market since the March bottom and being engaged on over 20,000 options trades individually. One individual who joined the market since the March bottom engaged in over 20,000 option trades. This is stunning. Stunning that what Robinhood did by turning the market into a video game market and encouraging the options gambling mania that invaded the market since March and artificially propping up the stock market higher. It is a house of cards, and the end will be disastrous. It will end in tears and unfortunately suicides. And here is more from the complaint. One of Robinhood's selling points to customers was that trading was commission free, but due in large part to its unusually high payment for order flow rates, meaning that they sell your orders to the highest bidder. Furthermore, Robinhood customers' orders were executed at prices that were inferior to other brokers' prices, meaning that Robinhood is giving you a much worse price than you would have gotten with Schwab, E-Trade, etc. But do you think that the Robinhoodites even care about that? They don't. To them, it's a video game. They punch a bunch of buttons, they buy calls, randomly expiring for the same week, way out of the money. And this strategy been working for them because it turned into a video game market. They look at their total account as like a video game scoreboard every day. Again, this will end in a disaster. And here is the regulator in his own words.
Not at all. I think what we really want to make sure is that these people are treated fairly. We do not believe they are. They're basically having the experience of trading, but it's a reckless experience because of the way that Robinhood has treated them. It's marketing themselves itself to them as a device by which they can become wealthy without having the expertise or the skill. Clearly, the practices that we outline in our complaint are dishonest and unethical, and those are things that we will not tolerate in Massachusetts. We also believe that they violate our state's fiduciary rule. They're clearly not putting their customers first. The fact that, as you noted in the lead to this piece, the number of outages, they've had over 70 outages this year. But the worst aspect of what they do clearly is the way they're gamifying the idea of investing. They're taking unsophisticated investors, most of whom have no experience, and basically making this into a game, causing them to suffer losses. They're bringing them aboard on something that these people absolutely have no idea about. In fact, they violated their own rules, the company's own rules on trading options. So it's very clear that this is a very reckless company when it comes to these investors. They're interested in expanding their market base. They're not interested in serving their investors.
Furthermore, Robinhood had to pay over $60 million to settle a claim from the SEC. This is a prior claim that they were selling order flows to the highest bidder.
Robinhood this day will pay $65 million to settle with the SEC on two key issues. The first, regulators say Robinhood didn't tell customers the whole story when it came to free trading. From 2015 through 2018, the SEC says Robinhood put misleading statements and had omissions on its website when describing its revenue model, namely payment for order flow or getting paid to send trades to high-frequency firms. Second, failing to get customers the best price on those trades. According to the SEC, Robinhood trades were executed at prices far inferior to other brokers. That's despite Robinhood saying its execution quality matched or beat its competitors. The SEC says in total, that cost customers about $34 million.
And today in the morning, we heard from the SEC chairman. And I wish I had this guy's job because all he does is wake up in the morning, put his suit on, and then go back to sleep. Because the SEC has been dormant, the SEC has been in a coma, while all of this gambling and market manipulation is happening every single day, going on unpunished. But how could they be blamed when the biggest market manipulator is the Federal Reserve of the United States of America. But here he is, Jay Clayton, the SEC chairman, in the morning, doing an interview with CNBC about a Chinese IPO that happened a few days ago. The company is unknown. Nobody knows anything about it. It is very shady. It IPO'd at $5 and it blasted all the way over $80 within days. This is the Robin Hoodiots effect. They buy first, ask questions later, aka the donkey mentality. They don't care what they're buying. If it's a new IPO, a new shiny object, they will chase it. And here it is, the SEC chairman describing what's going on in the market as euphoria. This is the SEC itself admitting that we are in a massive bubble of euphoria.
Well, Andrew, thank you. Thanks for having me on. And I do love it that Jim Cramer is provocative on these issues because he brings attention to them. Look, let me start on the regulatory side and talking about something like this. The SEC, we regulate disclosure, we regulate trading. I heard you mention about some limit up halts to give people a chance to pause and think about the price rise in particular stocks. We also regulate access to the markets. Who participates? Can retail participate freely? We are in a situation where, with mobile communications, access, and the like, there is a new paradigm. There are more retail investors participating in the market than ever before, and we're seeing that. And one thing that we don't regulate directly, Andrew, is euphoria. And we're seeing some euphoria here. I think I've heard other guests talk about euphoria. When stocks run away, like the ones you mentioned, we do get concerned because it is a situation where professional investors understand this. I do worry that retail investors, do not understand that trees don't grow to the sky.
And it did not take long before we heard from the SEC after all the criticism. And here it is. The SEC charges Robinhood with misleading customers about how it makes money. Robinhood is becoming a criminal organization. At the end of the day, you guys, young retail investors, will realize that Robinhood is a money sinkhole. You deposit your money, you enjoy it for a little while, you watch your gains in the video game scoreboard, and then one day, poof, the money disappears, and magically, it gets transferred to, here it is. Goldman is planning to boost bonuses for the trading division by up to 20%. Why not? Because Goldman Sachs is rolling in cash from the Robin Hoodiots gambling mania. And by the way, people ask me, you say that the stock market is overvalued and you wouldn't buy anything right now. But if you had to, which stock would you buy right now, this moment? Here it is, Goldman Sachs. When they report the next earnings, you will be stunned. Your jaw would drop down to the floor by how much money they made from all of this options gambling mania. And by the way, when the market crashes, they will also make money from all the surge in trading activities. Goldman Sachs, a no-brainer buy. Moving on to the iMob. To new viewers and new subscribers, what is the iMob? It is Apple Incorporated. Why do we call it the iMob or the Apple Mafia? Because this is a company that doesn't do innovation anymore. They don't grow their sales. They're losing market share all over the place. They cannot innovate anymore. They're not even profitable anymore when you compare it year over year. They're losing in net income. The picture is getting dire for this company. So they resort to milking their own customers for new garbage products. And the greatest example for that is the new $500 plus AirPods Max. But even this strategy is not working anymore because we saw a deceleration in the accessories revenue year over year. So what do Apple executives, aka the iMob, resort to doing? They are resorting to mob-like practices against app developers in their app stores. They shake down app developers for cash. For every dollar you make, you gotta pay us. You have to pay us the rent. Otherwise, we crack your kneecaps. And if we don't follow the rules, we ban you from our store. This is the iMob, ruling by fear, bullying, and mob-like practices. But here we have a big gorilla joining the fight on the people's side this time around. Facebook declaring war against Apple over upcoming changes to iPhone operating system. Here it is. Here is the declaration of war from Facebook against Apple. We are standing up to Apple for small business everywhere. And they give you all the justifications here on why they're doing this. Now, Facebook are no angels. They have their own wrongdoings. But again, in this fight, I am with Facebook. I am with Zucchiniberg. And I say, hit them hard. Hit the iMob where it hurts. But here is the iMob fighting back. Apple shot back at Facebook after the social media giant reignited a privacy war with a full-page attack ad. Now, here is my message to Zucchiniberg if he's watching this. Just ban Instagram from the App Store. Every Apple iPhone user would wake up one day and they cannot use Instagram anymore. And then all of these quote-unquote influencers who are posting selfies of their assholes on Instagram and their followers will get mad and the iMob will experience a massive backlash. People will threaten to switch to Android devices right away. Within one day, the iMob will be on their knees begging for mercy from Zucchiniberg. So Facebook, please, for the love of God, do this. Ban Instagram for one day on the Apple ecosystem. They will come down begging for mercy. And now, moving on to a new segment I call Space Assholes. Who are we referring to? The two richest men on the planet, Jeffrey Bezos and Elon Musk. And this time around, we're talking about Jeffrey Bezos of Amazon. Here is his ex-wife who's donated over $4 billion of her own money to charity. And here's what she said. This pandemic has been a wrecking ball for struggling Americans. And she said, the pandemic made the rich richer while wrecking others, and that donating money gave her hope. Good for Mackenzie Scott. She is a hero, unlike her asshole ex-husband. And indeed he is. He's no different than a slave master who owned mines back in the 19th century. Back when mine workers died inside and they pulled them out in stretchers, and the mine owner will yell and scream at other workers to stop grieving and go back to work. I'm not making this up.
One of the massive winners of this crisis has, of course, been Amazon, which was already destroying malls and small businesses before COVID came along. But now with people justifiably reluctant to leave their homes, Amazon has become even more of a monopolistic absurdity than it was before. Robert Reich actually crunched the numbers. This is incredible. He found that Amazon CEO Jeff Bezos has made so much money during COVID, he could give every single one of Amazon's workers $105,000 and still be as rich as he was prior to the pandemic. Of course, he's not going to do that. In fact, instead, he's going to hire Pinkerton goons, literally, to spy on any workers who dare consider organizing a union.
And here it is from The Guardian. Outcry over death on Amazon's warehouse floor. Quote unquote, go back to work. This is what Jeffrey Bezos is telling his workers. Go back to work. And if you do complain, I'm going to fire you. I will spy on you and your emails. And if you complain to anybody about the working conditions in the warehouses, you are fired and punished. You will be sued on top of that. This man is pure evil. And here it is. Amazon workers are now one of the biggest recipients of food stamps. Moreover, many Amazon warehouse employees struggle to pay the bills. More than 4,000 are on food stamps. Some are even homeless. Tax the hell out of the son of a bitch. Tax the hell out of him. But again, not every corporation is evil. Here are some good news, some good examples from Domino's Pizza. Domino's Pizza said this week that it would pay a bonus of up to $1,200 a piece to more than 11,500 hourly workers in December. Good for Domino's. It makes me want to order a pizza right now. You earn my business because you reward and appreciate your workers. Ask yourself, would you rather work for Amazon under the slavery of Jeff Bezos, or would you like to work for Domino's Pizza where they appreciate and reward their workers? And here is more corporate news for you for Boeing. A lot of people ask me if Boeing stock is a buy, and I say yes, but you gotta have a long-term outlook, because here it is. Boeing CEO says it may be 3 years more until we achieve a full recovery. Furthermore, we heard from Honda, and Honda's recalling over 1.4 million vehicles in the United States to repair drive shafts that can break, window switches that can overheat, and a software flaw. Now, if the most reliable car maker in the world, Honda, is having quality problems, then God help us all. And here's the thing. These new cars, regardless of the manufacturers, they're all garbage because they are designed to be leased for 2 to 3 years and then tossed away. I don't know if you remember Honda quality back in the 90s and early 2000 when they were manufactured in Japan. Those cars were designed and manufactured to live forever. They were designed and manufactured for ownership, not leasing. You can shoot a Honda Accord or Honda Civic from the 90s with a bazooka, and the car will still work and drive for hundreds of thousands of miles. Stick with old quality cars, Hondas or Toyotas, because even the newer ones from Honda and Toyota are garbage. Moving on to the heat map analysis, and what do we see here? Pretty much it was a sea of green across the board with few exceptions, so let's go through them. Right away, we see the technology sector is mixed. Semiconductors are muted. However, the software names scored massive gains. We're talking about Intuit over 3%, RingCentral almost 5% for the day, massive day again for Workday over 4%, ServiceNow almost 2%. And we do see a continuation of the strength in Square and PayPal on the heels of the massive rally in Bitcoin, but also for the fact that they will redistribute the stimulus checks and the PPP loans. Moving on to communication services, we see muted action for Google and Facebook, but the biggest loser of the day is AT&T, down over 2% for the session. Remember, I'm waiting for a dip so I can buy AT&T and perhaps a little more, and I'll be ready to acquire some shares in the name. The biggest winners of the day, we see Netflix up over 1.5%, Spotify almost 3% for the session, and Snapchat over 3% today. Moving on to consumer cyclicals, Amazon muted, but more gains for Alibaba and the Chinese names. And what do you know, Wayfair, after a series of declines being muted, trading downward, today is another day of gains for Wayfair, over 4% gains. And when we look at auto manufacturers, we see a massive gain for Tesla, 5%. A lot of traders are buying Tesla ahead of time, but specifically via call options. They're buying call options out of the money expiring tomorrow. And the assumption is during the rebalancing of quad witching, we will see a lot of buying of Tesla. That is the assumption. But be careful what you assume, because there are a lot of cute trickeries that can be pulled from money managers to dilute the impact of buying Tesla shares. We saw another day of gains for NIO, almost 3%. General Motors rebounding, almost 1.5% for the session. Toyota, Honda, muted for the day. All in all, we saw a massive day for consumer cyclicals. We're talking about International Paper, almost 1% for the session. On the weaker dollar, of course, and this is a name I own in my portfolio. The reopening names muted. We're talking about hotels, cruises, casinos not doing a lot, but we did see residentials. Lennar reported earnings. We saw Lennar closing over 7.5% for the session. D.R. Horton gaining on the heels, so did Toll Brothers. But the massive gains came from apparel retail. Ross Stores almost 3% for the day. TJ Maxx, Lululemon over 6%. Big gains for apparel and department stores, similar story. What about consumer defensives? Muted action. We saw gains for Mondelez, Budweiser, Coca-Cola, all the giants, Procter & Gamble. Meanwhile, the notable loser for the session here is in beverages. We're talking about Brown-Forman. This is the whiskey manufacturers, so no love for whiskey today. But maybe if we have a market crash tomorrow, this stock will ride higher because we're going to need a lot of shots over the weekend. Moving on to REITs, one of the overperformers for the day. We see American Tower closing in the green, Public Storage, another 3% gain for the day. Massive day for Equinix, Crown Castle, and the CoStar Group, the ticker CSGP. What about utilities? Also rebounding. Duke Energy, Dominion, American Water, Sempra Energy all did well for the session. Moving on, basic materials. The winner of the day. Massive gains for copper, gold specifically. We're talking about Barrick Gold. We're talking about New Mount. We're talking about Franco-Nevada, almost 3% for the session. And again, one of my favorite names, and now becoming the street's favorite name, Vale, closing almost 2% gains for the day. Energy, the laggard of the day, and the biggest loser here, the notable one at least, is Kinder Morgan, closing in the red by over 2%. What about industrials? Muted day for Boeing once again, down 2% or so, but we did see massive gains for the rest of industrials, specifically UPS, gains over 2.5%, so did FedEx. However, FedEx reported earnings after the bill, and last time I checked, the name is declining because it is impossible to meet the valuations of the stock right now, even though they reported very decent report. Airlines rebounding today just slightly, not by much. Moving on to healthcare. The notable winner, of course, as you can see evidently, Johnson & Johnson scoring over 2.5% for the day. We are waiting, of course, for the revelation of the vaccine from this company. In biotech, we see Moderna rebounding by the tune of 5% in the green. Good day for Abbott Laboratory, Regeneron, Vertex, and Diagnostics. Thermo Fisher rebounding slightly. Illumina up over 2%. So did Dexcom up over 1.5%. Moving on to financials. Berkshire Hathaway rebounding, but muted action for regionals and big banks slightly in the red. The notable gains here came from credit services, PayPal, MasterCard, Visa. However, the laggard of the day is Amex AXP. Moving on to the rotation trade. Any theme today? No, not at all. And we've been seeing this trend since early December. We did the rotation in November, actually started in September and pretty much ended in late November. And since then, we've been pumping the market all together. Not we, it is the quote-unquote mysterious entity. When you look at the volume in the overall market, it is actually muted, and there is very little retail participation during the day. They pump it overnight and then they pump it again by the end of the session. And this is what has been driving the market higher and higher. When you look at the charts, it is a series of gaps. This is very unhealthy. But let's talk about the rotation here. In the momentum names, we see gains for Peloton, Zillow, DocuSign, Tesla, Shopify, Netflix. These are the notable gainers. The laggards, the big tech names, Facebook, Google, even Apple lagging just by a little bit, even though closing in the green. Across the aisle for the reopening names. Again, all in all, it is a good picture. Gains across the board. The losses were very minimal, but the notable gainer here is Six Flags, closing over 3.5% for the session. Moving on to the charts analysis, starting with the 15 minutes of the SPY. What do we see here? A gap higher, and nothing happened. We just traded flat throughout the day, back and forth, and of course we saw the last hour pump pushing the indices slightly higher. Now, is there any valuable information here that we can read from this chart just looking at it by itself? Not really. It is in an uptrend. It is breaking out. It is gapping higher every night. The sky is the limit until and unless we see a reversal signal. And here is a daily chart, and this is what I've been talking about. The series of gaps go back all the way since the correction in September. Retail was participating in the summer, and after the correction in September, retail is pretty much all in. They did not do a lot. Some sold stocks, but the majority of them are still all in. There isn't more cash from the retail side to prop up this market. So what are they doing? They're doing it, the big guys we're talking about right now. They're pumping the market overnight, and you see, at least since the elections, the series of gaps. This is a very, very unhealthy technical wise, and it will be corrected in a very severe and violent fashion. I know that sounds crazy right now because people wake up and they see the market trending higher and higher every day. But remember what I'm saying here. Violent correction. When you gap like this, go back to the chart all you want. Go back to 18, 17, 15, whatever year, you're not going to see the market doing this, what we're seeing right now, the gapping higher in a consistent manner. It never happens in the history of the technical charts in the stock market. Moving on to the Qs, 15 minutes chart. What do we see here? Similar story, gapping higher, trading flat, nothing to see here. Anybody in YouTube or otherwise tells you that you can squeeze valuable information from looking at this chart is lying to you. There's nothing to see here. We're trading at all-time highs. The sky is the limit until and unless we see a reversal signal. And you gotta watch for the futures overnight because the reversal is likely to happen in the futures, not during the regular session. That is at least my take and my point of view. But moving on to the daily chart of the Qs, can we see anything different here? Not really. This chart is actually less healthy than the SPY because the gapping is more extreme here, meaning the correction will be a lot more violent in the Qs than it is in the SPY. I have all of these support lines for you, and my prediction is that once this charade is corrected, we will go down through these support lines like running your fingers through the strings of a guitar, and it will be sweet music to the ears of bears. Moving on to the dollar index, and perhaps the reason why the market rallied today, here it is. Remember what I said about Wednesday during Tuesday's video. I said Wednesday is a put up or shut up day for the dollar index. Either it's going to pop higher and we see the short covering scenario after the Fed meeting, or the dollar index will melt down immediately. And this is what we saw today. The dollar index sliding lower significantly. Usually, currencies don't slide by this tune for a single session. This is why it is very notable activities today that the dollar slid to this magnitude. Again, what happens when the dollar slides lower? You see Bitcoin rises and metals, specifically gold. So let's take a look at gold and see what's going on here. Climbing higher, closing above the resistance level of 1870, and I'm eyeing the level of 1925. I'm hoping and crossing my fingers that gold can make it all the way there so I can exit my position that I entered at 1800. Moving on to the VIX. And the VIX closing again in the red. Another day, another decline. However, it is not a severe decline for the VIX, even though we saw a hat trick of new record highs in the indices. And the question is the VIX melting down just like the dollar index? And that's it. We're going to see a melt up scenario in the stock market, and it will be the end of the volatility index. Here's my take, and I'm willing to take the risk of being mocked later on. I am betting that the VIX is recocking the gun, and it will give it another shot, a very extreme one, to finally, once and for all, crack and close above the very important and pivotal level of 25. And I'm putting my money where my mouth is, and I bought call options contracts for the VXX. Do not do it. Heed this warning. Do not do it via the UVXY. The UVXY is a money sinkhole. You buy calls in the UVXY, I guarantee you there is a 90% chance you will lose your money. How do I know? From past experience. I've been trading the VIX for years now, and the only time where I made money buying call options in the UVXY was back in 2015 during the whole Brexit fiasco. Other than that, every time I bought call options in the UVXY, I lost money. Stay the hell away from the UVXY. You use the UVXY if you want to short the VIX, but you use the VXX if you want to go long the VIX. Take that as a rule. Moving on to yields. What do we see here in the TNX? Again, this is the mid finger to Jerome. He tried to scare yields yesterday. Today, we're giving the mid finger to Jerome. We're calling his bluff and bullshit. And you see yields climbing higher once again. We're inching closer and closer here, the very important psychological level of 1%, and pay attention to the conclusion of the video because I'm going to revisit this particular subject. Oh, and by the way, what happened to the TLT, the long end treasuries? Remember yesterday I told you we have this descending resistance line, but we did the double bottom formation and we are ready to crack higher. We did that indeed in the morning, gapping higher. However, we saw the reversal right away, and the TLT went all the way back where it started. Now, usually, we look at a rise in the TLT as a sign of risk off because we see more demand for bonds. But when we see declines in the TLT, that is a signal for risk on in equities. And this is exactly what we've been seeing for a while now. Here is the catch. If the mania continues and we see exodus from the TLT into equities pushing higher and higher and higher, eventually the TNX and yields will reach 1%. I know that 1% is a low number, but it is a very important psychological level, and it could be the igniter for the correction. Stick around again for the conclusion. Moving on to Apple, let's see what's going on here from a daily perspective. First off, here is the new level of resistance, 131. We closed well above the very important level of 120. We are one resistance level ahead of 120. We've already beaten the 125. Apple looking very strong here, very bullish, making a series of higher lows and marching forward all the way to the next resistance level of 131. Is it going to run out of steam at some point? It could be, but we have to see a signal for that first. Looking at the chart right now, there is no sign of exhaustion or a reversal. The rally continues in Apple until we see a reversal signal. Moving on to Tesla, the big kahuna for tomorrow and the next upcoming week. What do we see here? Another green day for Tesla. Remember, we have the ascending resistance line in yellow. It is a range that Tesla has been trading on since the beginning of the year. However, we could see a lot of momentum tomorrow to push Tesla to break above the resistance line. That is the assumption, of course, that most market participants are assuming, that we will see an influx of buying for Tesla shares. I warned you again that we could get disappointed here. But if the assumption is correct, Tesla will trade higher. And where is the level from which I will be comfortable to short Tesla? Take a look at the RSI, 84. We never got there since the beginning of this S&P 500 inclusion rally. But if we get there, I will be shorting. For now, the party goes on. And now, moving on to conclude this video. Remember what Jerome said yesterday? He said, don't worry, stocks are not overvalued because you don't need to look at PE ratios anymore. Those are insignificant because the lower 10 years treasury yield. But what do we continue to see every day? The TNX, the 10 years treasury yield, continues to climb higher every day. So here is the tweet that I issued in the morning. Jerome Powell told me yesterday to buy stocks regardless of valuations. My response is, you first. If the Fed wants me to buy stocks right now at these very high elevated valuations, I want to see commitment from the Federal Reserve to expand and extend their assets purchasing programs. Otherwise, they're telling us to dive head first, Naruto style, buy stocks, pay no attention to the valuations whatsoever, but they're not willing to offer any insurance. Furthermore, here it is. Corporate insiders not buying much of their own stock lately. They timed the March bottom, but they've been selling in November. And I show you every time the insiders selling activities. They're dumping millions, hundreds of millions worth of shares like there is no tomorrow. And they're not buying their stocks. Now ask yourself the question. If Jerome is right and we should pay no attention to valuations, we should just buy stocks right now because of the lower yields, why aren't corporate insiders buying their own stocks? Because Jerome gave us the green light. He said party like 1999 and then some. Why aren't corporate insiders buying? Because they know that their financial results will not live up to the valuations, specifically if they are stretched even higher from here. Again, you want me to buy stocks? Fine. I'd buy stocks right now, but I want commitments. I want the Federal Reserve to expand the assets purchasing program, and I need corporate insiders to go first. And then I'll follow them. I got no problem to go Naruto style, participating in the donkey mentality of buying first, asking questions later. Matter of fact, don't ask questions. This is what Jerome told us yesterday. But the most alarming sight right now is the fact that this bubble is becoming a global synchronized mania. What do I mean by that? Central banks across the world decided to save the stock market and corporations by printing fake money out of thin air, continuing to devalue their currencies, and they're following on the lead of the United States market. My fear is that this globally synchronized mania bubble will pop together, and you thought that we're done with the crisis of the coronavirus and everything is green and the sky's the limit from here? Wait till this global bubble pops. Then what? Central banks already exhausted their tools and their ammo fighting the coronavirus crisis. Now we're going to have another global market crisis, market crash, and we're going to have a Federal Reserve and central banks that are already exhausted. Are you starting to see the danger now? Example, here is the German stock market, the DAX. It is already trading at all-time highs from a monthly closing perspective so far. Ask yourself, is the German economy better now before COVID-19 crisis? We're talking about an economy that is not built up on technology firms. What do they got? They got SAP? What else? It is an industrial-based economy, meaning that the way for recovery in the German economy is way, way longer than anybody expects. And here it is. Germany will sell a record 576 billion in debt next to help prop up the economy in the second year of the coronavirus crisis. And why the hell is the German stock market trading pretty much at all-time highs? Example number 2. Here is the Indian stock market, the Sensex. It is joining the mania. It is globally synchronized mania right now. Check out the vertical move in the Sensex. Ask yourself, is the Indian economy doing better now than before the coronavirus crisis? What changed? Or is this another disastrous bubble dragging all of these retail investors in to crash the house on the top of their heads and make the rich richer? Remember, there's only one guy here that owns the entire country of India right now because he's getting richer and richer every single day. Meanwhile, here it is. As many as 80% of Indian students could not access online schooling during the lockdown, and many might not return to classrooms when they open. Ask yourself, is the Indian economy going to do better after the coronavirus crisis? After all the scarring, is it going to do better than before? Where is your head? Furthermore, here is the Japanese stock market, the Nikkei. Remember, after the bubble burst in the early 90s, this market has been consolidating for 30 years. All of a sudden now, it is breaking out impulsively to break the consolidation of 30 years. Ask yourself, is there anything that changed in the Japanese economy to make it better than it was before the coronavirus crisis? Hell no. This is starting to look like somehow of a global reset where they're trying to squeeze every penny from the poor and the middle class, transfer it to the rich all over the world, and then crash this market once and for all and leave everything in the dust. I don't believe in these conspiracy theories, but you cannot help but to think about them when you see this globally synchronized market mania. And here is the last thing I want to conclude this video with. Where do we go from here in the US market at least? Here is the melt up scenario versus the crash scenario. The melt up could continue and it will drop your jaw to the floor. The Dow could be trading at 33,000 by January if this scenario comes to life. Number 1, FOMO. Number 1, a larger than expected stimulus. And number 3, the US dollar crash. Now remember, retail participation, they're already all in. But what if we hear that more and more amateurs, mom and pops, grandmas are joining the market again because they're experiencing FOMO? We just hit a hat trick of record highs today. You think this headline doesn't make somebody working hard every day, barely earning a living, saying, what the hell am I doing? Why shouldn't I deploy some money in the stock market? If we do see that and the FOMO intensifies, combine that with a larger than expected stimulus and a continuation of the weakness in the US dollar, we will see a melt up like you have never seen before. However, it will be extremely dangerous because the burst of that particular bubble will create a global crisis. Now here is the panic crash, sell-off, whatever you want to call it. What would be the catalyst? Number 1, a fallout in Brexit. They continue to tell us every day that Brexit is going fine. They're inching closer and closer to an agreement, but nothing concrete is taking place. What the hell is going on here with Brexit? Number 2, if the stimulus is smaller than expected and then we don't get anything after that, that would be disastrous for the stock market. Number 3, and now it's getting a little more interesting, the Tesla inclusion bomb. What if the inclusion of the biggest bubble, the most overvalued stock in the S&P 500 in terms of size, creates a burst, or nobody wants to take the risk of buying this particular name at this valuation, and we see a mass exodus out of the S&P 500. That could be the catalyst for a correction, even a crash, because at this point everybody's trading and investing in margin, and as these margin calls start to hit, you run into the quote-unquote domino effect. Here's the last factor, heading 1% in the 10 years yield. Now you might say that 1% is a small number, it's a joke, etc. But from a psychological perspective, hitting 1% is an important milestone, telling us that the 10 years Treasury yields could climb even higher. And with the extreme valuations that we have right now, according to Jerome, not me, 1% could be a little too much here for the valuations that we have in the market right now. Because, again, the market looks forward, and if the market sees 1.5%, even 2% yields in the future, these stock multiples must be contracted. End of the story. So this is my outlook here. This is what I'm watching for. I hope this video was helpful to you, because that's all I got for you today. I'll talk to you again during the weekend.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.